Hello. Thank you for entrusting me with the opportunity to guide you through your investment decisions. Today, I will be presenting a carefully tailored investment portfolio designed to optimize your recent inheritance of £100,000. We will focus on achieving a balance between liquidity and growth, managing risk effectively, and understanding the tax implications of each investment type. Let us start with a quick overview of the different types of investments available. So there are several investment vehicles at our disposal. First are the equities. These equities include index funds, UK dividend stocks, and thematic stocks. These offer potential for high returns, but also higher risk. These stocks are shares of company ownership that yield returns in the form of dividends and capital gains. Secondly are the bonds. These are the government and corporate bonds that provide more stable and predictable returns, acting as a safeguard against market volatility. These are debt securities that provide regular interest income. Thirdly, thirdly are the alternatives, which are the investments such as real estate investment trusts or REITs and commodities such as gold, which add diversification and can hedge against inflation. And the fourth type are the cash and liquidity. High interest savings accounts and money market funds offer liquidity and safety for immediate financial needs. Now, let us go to the equities analysis. Let us dip dive into index funds, UK dividend stocks, and thematic stocks first. Beginning with the equities, firstly are the index funds, which have allocated 30% of the £100,000, and consecutively of the two index funds, I've equally distributed £15,000 each. So first is the UBS S&P 500 Index Class C accumulation, and the other is the UBS FTSE RAFI Developed 1000 Index Fund. Now both funds have similar standard deviations, with the UBS S&P 500 Index Class C showing a standard deviation of 13.77 and the UBS FTSE RAFI Developed 1000 Index, both with betas that are near 1, indicating that their performance closely aligns with the market. One reason for this investment is because these funds offer broad market exposure, mirroring the performance of large segments of the global market. And as we can see, they are mirroring the S&P 500 index and the FTSE RAFI Developed 1000 Index Fund. Now, as they mirror this indices, it reduces unsystematic risk and provides a diversified investment base. One benefit is that historically, equities have outperformed other asset classes over the long term in terms of return. Index funds, in particular, offer lower fees and are tax efficient, making them an ideal base for any growth-oriented investment portfolio. Their inclusion capitalizes on the market's overall growth potential without the need to outperform the market. Secondly, are the UK dividend stocks. As you can see on the spreadsheet, I've allocated 10% of the £10,000 and have chosen different five different companies and have equally distributed £2,000 each. Companies like the BT Group PLC and Unilever PLC provide a blend of yield and potential capital appreciation. These stocks have lower betas. As we can see on the spreadsheet here. They are all less than 1, which indicates less volatility than the overall market, which makes them suitable for conservative investors seeking steady income. The high earnings yield and the dividend cover of stocks like Unilever suggests profitability and ability to maintain dividend payments. For returns and stability, for example, Unilever offers a significant expected return of 36.8%, with a moderate beta of 0.8, suggesting less volatility compared to the broader market. This blend of high return potential with lower risk makes it an attractive option for dividend-seeking investors. One more benefits of purchasing the dividend stocks is that dividend-paying stocks tend to be less volatile than non-dividend stocks and provide returns even in bearish market conditions. Companies like Unilever and Admiral Group also demonstrate strong market positions and robust business models, enhancing portfolio stability. Now let us move on to thematic stocks, which have also allocated 10%, whereas here I've chosen 4 companies related to technology. One reason for investing in thematic stocks is that they are selected based on specific forward-looking themes such as technology and innovation, which are expected to outperform the broader market in the long run. One benefit is that these companies are positioned in high-growth industries and have the potential to generate significant capital gains. Their high risk is balanced by their high growth potential, suitable for part of a diversified portfolio aiming for higher returns. Now let us move on to the bond investment insights, and let us analyze some of the government bonds and corporate bonds that are prepared for today. For the bonds, let us begin with the government bond, and we have here the UK 10-year gilt. This government bond is a low-risk investment, providing a fixed income with a coupon rate of 4.25%. It is particularly appealing for risk-averse investors due to its government backing and fixed income until 2036. As we can see here, I've allocated 15%, which is equivalent to £15,000 for the government bond. And for the reason of investing, government bonds are considered one of the safest investment forms, providing a predictable income stream and principal protection. One benefit is that the stability of government bonds is crucial for risk management, acting as a counterbalance to the more volatile equity holdings in the portfolio. Following the government bond is the corporate bonds, which have also allocated 15%. I've chosen the Aviva PLC AE57. This bond offers a floating rate which adjusts with market interest rates, providing a yield typically higher than that of government bonds. The 6.1250% rate reflects its slightly higher risk relative to government bonds but offers better compensation for those risks. A reason for investing is it offers higher yields than government bonds, suitable for investors seeking for better returns without excessively higher risks. Corporate bonds like Aviva PLC add diversification and an additional layer of income generation. The floating rate nature of Aviva's bond offers an inflation hedge as the payout adjusts with interest rates. Let us now move on to the alternative investments and liquidity. Let us talk through the benefits of REITs, commodities, and liquidity options. For the REITs, I've chosen Asura and have allocated 5% of the £100,000. So these Asuras are real estate investments that offer a hedge against inflation and provide diversification away from equities and bonds. Asura, an REIT, offers exposure to healthcare real estate, a sector with potentially lower volatility and steady demand. So let us talk about stable returns. Asura shows an expected return of 2.82% with a relatively low standard deviation of 6.29%, which indicates lower volatility, making it a solid choice for stable income generating investments. REITs provides exposure to real estate markets without the need to invest directly in property. REITs like Asura, which focuses on healthcare facilities, offer stable rental incomes and potential capital appreciation. they are particularly resilient due to the essential nature of their properties. One more alternative are the commodities. As you can see, I've allocated 5% and I've chosen gold to purchase. Gold is a traditional safe haven and hedge against currency devaluation and inflation. It does not yield income but can appreciate in value during market downturns or periods of high inflation. Let us now move on to the cash and liquidity. Um, for the high interest savings and the money market funds, I've allocated 5% each, and I've chosen First Direct for high interest savings and Sterling Short Term Money Market Fund for the money market funds. High interest savings accounts and money market funds ensures that a portion of the portfolio is readily accessible for any immediate financial needs or opportunities. These instruments offer safety, liquidity, and small interest income, which is crucial for managing short-term cash requirements without compromising on earning potential on idle funds. Efficient market hypothesis. The EMH suggests that all publicly available information is already reflected in stock prices, and therefore, no investor can consistently achieve higher returns through stock picking or market timing. This theory is a crucial foundation for our investment strategy, particularly in our choice of equities. A significant trend that illustrates the influence of the EMH is the rise in popularity of index funds. These funds, which include both mutual funds and ETFs, are designed to passively track the performance of a market index. For instance, in your portfolio, the UBS S&P 500 Index Class C and the UBS FTSE RAFI Developed 1000 Index Fund are prime examples of such investments. Now let us go through the tax implications across the investments. For the equities, the dividends received from UK stocks are subject to UK dividend allowance, which currently allows you to receive 500 pounds of dividend tax-free each year. The dividends above this threshold are taxed at rates depending on your income tax band, 8.75% for basic rate taxpayers and 33.75% for higher tax rate payers. Capital gains. When you sell shares for a profit, the gains are subject to capital gains tax. The annual exempt amount for individuals is £3,000, beyond which gains are taxed at 28% for managing and investment funds. For the bonds in the gilts interest from UK government bonds is taxable as income. However, gilts are free from capital gains tax. Corporate bonds bought directly from the issuer and issued in pounds are also not subject to capital gains tax so long as they are deemed qualifying corporate bonds by the HMRC. Other types of bonds are subject to capital gains tax unless held inside an ISA or other tax-free wrapper. For the alternatives, REITs have unique tax treatments. Income profits and capital gains of the qualifying property rental business of the REIT are exempt from corporate tax. Distributions of income profits and capital gains by the REIT are treated as income from a property rental business in the hands of investors. 20% withholding tax is imposed on any distributions made to investors subject to exemptions. Commodities such as gold. While our commodity, gold, does not generate income, our commodity, gold, wait, now for the commodities. While gold does not generate income, any profits from selling the gold is subject to capital gains tax. However, investment-grade gold coins produced by the Royal Mint like sovereigns or Britannias are exempt from capital gains tax. For the savings accounts and money market funds, interest received from these sources are subject to income tax. However, the personal savings allowance permits basic rate taxpayers to earn 1,000 of interest per year tax-free, reduced to £500 for higher rate taxpayers. Additional rate taxpayers do not receive this allowance. Now, in conclusion, This portfolio is designed to meet your financial goals by blending growth with security, optimizing tax outcomes, and maintaining sufficient liquidity.